Welcome to Module 7c. I'm Cindy Simpson, and we're going to be covering Module 7c, Accounting Changes. Now, I know that John writes this all down for you, and he puts it on like a piece of paper. Okay, but I just want to tell you, this is the multiple choice that you should do, and plus there's like a serious kind of like typo in one of the simulations that I signed, so I wanted to like correct their typo. But for the module, like I just had you with Module 7a, and I told you all the keywords were on the handout on pages 1 and 2 of the Financial Accounting and Reporting handout, but there are some other keywords in every module, and I'll tell you to check out these words, and they will help you with your research. They're like search terms, these keywords. You don't have to memorize them, you just have to have a familiarity with them. I'll show you the keywords. Also, Module 7c, which is accounting changes. These are the multiple choice questions I want you to do. Multiple choice questions number 2, 3, 9, 13, 14, 15, 16, 17, and 18. Then 20 and 21, and then 25 and 26. There's a simulation that I want you to do. I want you to do simulation number 2. There's only one section, though, I want you to do in it. It's simulation number 2, the accounting change section only. I want you to do the accounting change. Believe me, that's enough work. The accounting change section only. It's found on page 118. Also, they give the solution, but there's a typo in the solution. The typo in the solution is found on page 126. Let's just correct that typo really quick. If you turn to page 126, on page 126, in the very middle of the page, they say explanation of the solutions. Right above it, they have December 31st, 2008, December 31st, 2007. They have inventory, income tax liability, and retained earnings. The number for retained earnings under December 31st, 2008, it's wrong. They have it as 16,800. That is wrong. It's not supposed to be 16,800. It's supposed to be 22,800. They actually do the whole calculation correctly. If you look at the very, very bottom, page 126, the very last line of page 126, you can see retained earnings at December 31st, 2008 is 22,800. All right, that's the right number, but they forgot to put it in the table. So they calculated it right and put the wrong number in the answer. So the retained earnings under December 31st, 2008 in the very middle of the page, it's not 16,800, it's 22,800. So please make that correction for that typographical error. There are also 10 keywords. Let me tell you what the 10 keywords are. If you look on page 110, oh, I lied, 111, sorry. Cindy, I'll tell you. 111. Here are your keywords on here, okay? The keywords are on page 111. The keywords are going to be change in accounting principle, number 1. Then number 2 is change in accounting estimate. Then number 3 is change in reporting entity. So change in accounting error, all right. Change in accounting principle, change in accounting estimate, change in reporting entity. There's 3 of them. Then the 4th one is going to be retrospective application. The 4th one is in the bold print at the bottom. I'm on page 111. I'm looking at the table. So the first one is change in accounting principle. The second one is change in accounting estimate. The third one is change in reporting entity. The 4th one is retrospective application. That's sort of like in the middle of the table. Then they have number 5 will be prospective treatment. Number 5 will be prospective treatment, okay? And then we have number 6, which is retrospective application. Number 6 then is going to be retrospective application. Then the 7th one will be correction of an error. The 7th one is going to be correction of the error, okay? Correction of the error. Then down right below it, it says correction of an error. It says number 4, correction of error. That's going to be your 7th term. And then also the 8th term is going to be restating the financial statements. The 8th term is going to be right below it. They have a sentence that says a correction of an error in previously issued financial statements requires a prior period adjustment by restating the financial statements. Okay? So restating and restatement. That restating and restatement is your 8th term, okay? Then your 9th term is going to be the prior period adjustment, okay? And then your 9th term is prior period adjustment, and then your 10th term is just the title of this module, which is accounting changes. All right, the 10th term is accounting changes. Okay, so you have 10 terms altogether. The terms are, just check them off. Just put a check marker. Number look at the table at the bottom, page 111. Number 1, change in accounting principle. Number 2, change in accounting estimate. Number 3, change in reporting entity. Number 3 is change in reporting entity. Then in the middle, okay, under financial statement treatment, the 4th term is going to be retrospective application. The 5th term is going to be prospective or prospective treatment. The 6th term is going to be retrospective application. Retrospective application. Now, you know, they have retrospective application up at top, number 4, and then retrospective application. I want to add another one there, and that would be retroactive, which is something that they don't use anymore. Okay, I'll spell it out for you. Retroactive. Okay, so add that there. Under where it says retrospective application, the old accounting standard used to be retroactive. Okay, that's the old accounting standard. They don't use that term anymore. They use retrospective. So that's your 6th term. Your 7th term is item number 4. Above the table, it says correction of an error. That's the 7th term, correction of an error. Number 8 is restating the financial statements. It's right below it in the sentence, restating a restatement. Number 9 is prior period adjustments. It's in the same sentence, prior period adjustments. That's the 9th term. And the overall, the 10th term is then accounting changes. Okay, accounting changes. All right, so there then are your 10 terms. So we had 10 terms. These are your keywords. All right. I like to always just go over keywords because I think it's just a good idea to give people keywords so that things that they can search. The reason I point out the word retroactive is that although they don't use it anymore, you might see it in a lot of problems, and it is an old accounting standard that they don't use anymore, but just remember that that's old and it's now been replaced with the word retrospective, okay? So under the financial statement treatment, you have retrospective, prospective, retrospective application. The old term was retroactive, so I just want you to write it there, but they don't use that anymore. Remember to also do the simulation. Okay, now that we've done that, I do have a very nice handout for you. The handout is found on pages 3 and 4 of your financial accounting and reporting handout, and I sort of take the whole chapter and I summarize it for you. We are also going to take a look at some of the disclosures that are required. Standard number 154 has been around for about at least 3 or 4 years. I remember back in 2006 we had to do both of them, the old standard and the new standard. We don't have to do that now for 2009. You only have to know the new standard. But see, I do realize that some of you were in school a while ago, and so the handout is specifically geared to assist people who learned the old accounting standard. And I'll tell you, we no longer do this like they did in the old accounting standard. We now do this in the new accounting standard. So it just sort of helps people who are in school 5 years ago or more, or 4 years ago or more, and learn the old accounting standard. It just helps you, okay? Because it's only been around since 2006, all right? Well, on the exam anyway. All right, so on pages 3 and 4 of your FARE handout, let's just take a look at this. It says this handout summarizes the treatment for accounting changes under standard number 154. Standard number 154 is effective for accounting periods beginning after December 15, 2005. So it's been tested in exams since 2006, okay? It allows early application after its issuance date of May 2005. Let me tell you something, folks. Although I read to you in the beginning of the book how if something allows early implementation or allows early application, okay, that they can start testing it 6 months after the issuance date, and you don't have to wait until the effective date because it allows early application or early implementation. The exam rarely does early application or early implementation, rarely, okay? Let me tell you why. Because in every single question that they give, they would have to say, this company elects early implementation, or this company elects early application of that standard. And that's just too much work, right? So they rarely implement anything early. And most companies rarely implement anything early too, okay, all right? They wait until the very last minute, okay, to implement anything. Okay, so it allows early application after the issuance date of May 2005. In case students learn accounting changes under the old standard, which is APB opinion, Accounting Principles Board opinion number 20, significant changes that occurred as a result of standard number 154 have been highlighted. So I tell you, well, this is a big difference. All right. One of the things that's really different is they never use the term retroactive anymore. It's called retrospective because they just love to change the terms, okay? Also, something that's new is they specifically reserve the term restatement for correction of an error. So before, people used to say restate this, restate that. No. The only time you ever say the word restatement now under standard number 154 is to correct an error. Okay, let's take a look at my handout on page 3. Statements of Financial Accounting Standards number 154. This is accounting changes and error corrections. This is a replacement of Accounting Principles Board opinion number 20 and a FASB statement of Financial Accounting Standards number 3. Okay, under accounting changes, similar to the old standard, there are still just 3 kinds of accounting changes. The 3 types of accounting changes are change in accounting principle, change in accounting estimate, changes in reporting entity. So there's still 3 kinds. There is no change in the definition and treatment of corrections of errors. Corrections of errors are not accounting changes. You have to understand. They try and fool you with that on the exam. Is a correction of an error an accounting change? No. Accounting changes are only changes in accounting principle, changes in accounting estimate, and changes in reporting entity. Corrections of an errors never have been accounting changes, and they still are not accounting changes. Corrections of errors are done as prior period adjustments. Now remember, corrections of errors, prior periods of adjustments, okay, these are both key terms for you. They're done as prior period adjustments to the beginning balance of retained earnings, and they're done net of tax effect. However, the term restatement is reserved only for describing a correction of an error to the financial statement. Remember the word restatement, that was another one of your key words, okay? When discussing financial statements, it may be helpful to remember that when you are a publicly traded company and you file with the SEC requires you to report 3 years of comparative statements for the income statement and statement of cash flow, and 2 years of comparative statements for a balance sheet. That means that if you're filing an income statement and a balance sheet and a statement of cash flow with the SEC on your Form 10K, the SEC for publicly traded companies, those are the ones that have to file with the SEC, on your income statement and your statement of cash flow, you have to file for December 31st, 2009, you'll file an income statement and a statement of cash flow that has 3 columns of information: December 31st, 2009, December 31st, 2008, December 31st, 2007. You must present 3 years comparative financial statements for the income statement and the statement of cash flows. For the balance sheet, you only have to do 2 years. Why? That makes absolutely no sense, but that's what it says on Regulation SX in order to comply with filing your Form 10K with the SEC. So if you're publicly traded, for income statement and statement of cash flows, it's three years comparative statements. For the balance sheet, it's only 2 years. So for December 31st, 2009 financial statement, you have a balance sheet at December 31st, 2009 and a balance sheet at December 31st, 2008. And they're called comparative statements because the 2 columns are side by side on the balance sheet. On the income statement and statement of cash flow, it's 3 years. So I just wanted to keep that in mind. All right, letter A, changes in accounting principle. Number 1. Now, I will tell you that changes in accounting principle are difficult, okay? Changes in accounting estimate and change in reporting entity is not that difficult. Okay, changes in accounting principle. Let's start with the most difficult one. First of all, let's drop down to number 2, which is about 3/4 of the way down the page on page 3. Exactly what is a change in accounting principle? Number 2. 3/4 of the way down the page. What are changes in accounting principle? This is any change from one generally accepted accounting principle to another generally accepted accounting principle. So what are some examples? 2A, any change in an inventory flow method. So if you change it between LIFO, FIFO, weighted average, or moving average. Any change from one to the other, okay? Letter B, any change in construction accounting method, such as changing from percentage of completion to completed contract or vice versa. All right. Please note that any change in the depreciation, amortization, or depletion method is now considered to be a change in accounting estimate. Now, under the old accounting standard, if you went from straight line method to double declining balance method of depreciation, that used to be called a change in accounting principle. No more. Under standard number 154, going from the straight line method to the double declining balance method of depreciation, changing any depreciation method, amortization method, or depletion method is now considered to be a change in accounting estimate. Why? It's so stupid. Stupid, by the way, is not a technical accounting term. Why? Because that's what the accounting standard says. We probably did it to make us more comparable to international standards. Yeah. Because, you know, U.S. GAAP is converging and becoming more and more like international GAAP. So that's probably the reason we did it. Also, no distinction is made now between special and non-special changes. All changes in accounting principle are now treated in the same manner. Those of you who learned the old accounting standard, there used to be special changes. The special changes was going from LIFO to anything else, any changes in construction accounting. No more. There's no more special changes given different type of treatment. They're all considered to be exactly the same. Okay, so if you change from LIFO to FIFO, it's treated the same way as FIFO to LIFO. Right? If you change, your construction accounting is treated just like any other change in accounting principle. Okay? But remember, a change in depreciation method is a change in accounting estimate. Why? I have no idea. That's just what the accounting standard says. You also have to know, at the bottom of page 3, there's something called the direct effects and the indirect effects. Okay? Now, they're not going to really ask you to apply the direct effects and apply the indirect effects. You just have to know exactly what the definitions of them are. Okay. So number 3 says, what are the direct and indirect effects of the cumulative effect? So what are the 3A, the direct effects of the change in accounting principle? 3A, the direct effects of the change in accounting principle are effects of the assets. I'm at the very bottom of page 3 of the Financial Accounting Reporting handout. The direct effects are the effects on the assets, the liabilities, the deferred income tax assets and deferred income tax liabilities, and the impairment losses as a result of the new accounting principle. You just have to memorize it. Asset, liability, deferred income tax asset, deferred income tax liability, impairment loss. These are the direct effects. So what are the indirect effects? The indirect effects, the classic examples are royalties and profit sharing. Indirect effects are effects to current and future cash flows as a result of the new accounting principle, and there are royalties and profit sharing. Okay, so you have to know examples of direct effects, you have to know examples of indirect effects. Now let's look in the middle of page 3, letter A, changes in accounting principle. Now that we know what is a change in accounting principle, now that we know what is the direct effects and indirect effects, let's just see what are you supposed to do with these changes in accounting principle. A1, steps in dealing with changes in accounting principle. 1A, when you make the decision to change your accounting principle, you do it as of January 1 of that accounting period in which you make the decision. So if I make the change, if I decide to make the change in 2009, you make the change as of January 1st, 2009. So just use the new accounting principle beginning January 1, 2009. Letter B, then you must take the cumulative effect. The cumulative effect is the difference between the old principle and the new principle since the company first started business until the beginning of the first period presented. Now remember, the first period presented, it depends. If you're talking about 2009, okay, then for the income statement and the statement of cash flow, you have to present 2009, 2008, and 2007 on your income statement and statement of cash flow. For the balance sheet, you have to present 2009 and 2008, only 2 years. So you take the cumulative effect from when the company first started business until the beginning of the first period that's presented. Remember, you have to do 3 years comparative statements for income statement and statement of cash flow, 2 years comparative statements for the balance sheet. And then you adjust the carrying values and of the assets and the liabilities as of the beginning of the first period presented. Little I, one little I. The offsetting debit or credit is made to the beginning balance of retained earnings net of tax effect for the first period presented. 2 little i's. Only the direct effects are part of the cumulative effect. Number 3 little i's. Indirect effects are reported in the period which the change is made. The indirect effects will only be reported in 2009. Okay? Letter C, the presentation of prior periods in comparative financial statements. The financial statements of each prior period presented is then adjusted for a period-specific effect. So you bring it all the way back to the beginning balance of the first period presented, the cumulative effect. Then you adjust specifically how would that change affect 2007, 2008, and 2009 for the income statement and the statement of cash flow. Okay? Treatment described in A, B, and CI above is called retrospective treatment. Retrospective means you recast the financial statements as if you had always used the new accounting principle in 2009, 2008, and 2007 for your income statement and your statement of cash flows. For the balance sheet, it will be just 2009 and 2008, right? Because it's only 2 years. Retrospective treatment means you apply the new accounting principle to the prior period's financial statements as if the new accounting principle had been used in those periods. 2 little i's. However, if the cumulative effect can be calculated, but if the period-specific effects can only be determined for some of the prior accounting periods presented, but not all of them, then you just do C little i's. All right, the period-specific, I can't even talk anymore. The period-specific effects to the earliest period a prior period possible, and they adjust that prior period's beginning balance for assets, liabilities, and retained earnings. That means if you can't figure out the period-specific effects for all 3 years for the statement of cash flows and the income statement, just do it for what you can. Okay, is what they're saying there. Then 3 little i's. If the cumulative effect can be calculated, but the period-specific effects can't be determined for any of the prior periods presented, then just apply the new accounting principle prospectively. So they're saying, well, if you can't figure out the period-specific effects for 2008 and 2007, then just treat it prospectively, which means the accounting change takes effect in 2009 and you move forward. You don't even recast 2008 and 2007. Why? Well, that's just the way they say, So what do you think most companies are going to do? We can't figure it out. Let's just treat it prospectively. Prospective means it affects this year and future years. But really, you're supposed to try your hardest, take the cumulative effect, adjust the beginning balance of the first period presented, and then do the period-specific effects for each year that you present in the comparative statement. Now, unless you can't do that, then you just do what you can, or if you can't do anything for doing what you can for those prior periods, and just do everything in this year. All right. Let's see if we can take a look at some multiple choice questions on this. Let's see if we can take a look at multiple choice question number 9, please. Multiple choice question number 9. Multiple choice question number 9. Number 9 is found on page 112. So let's take a look at a multiple choice question on that. Number 9 on page 112 says, retrospective application would result in what? Okay, number 9 is retrospective application would result in what? On January 1st of 2009, the Rome Corporation changed its inventory method to FIFO. So FIFO is a new method, and LIFO is the old method from LIFO. So LIFO is the old method, FIFO is a new method for both financial and income tax reporting purposes. This change resulted in a $500,000 increase in their January 1st, 2009 inventory, which is the only change that could be calculated from their accounting records. Assume the income tax rate for all years is 30%. Retrospective application would increase in, okay, well, first of all right, it doesn't say that they're doing anything that's a comparative statement. Okay, it doesn't say that they're doing anything that's a comparative statement. Okay, but usually what happens is that you would adjust the beginning balance of the earliest period presented. Okay, but it doesn't even say that they're doing comparative statements here. So let's take a look at this. Number 9. Now, whenever you have a theory type question like this, which means there's no numbers in the answers, what you try to do is to eliminate yourself from always picking A when it looks good, all right, because remember, A is the most, they like to put as the most often chosen wrong answer. Start with letter D and work your way up. We did this a lot. If you had me for BEC, we did this a lot in BEC because there's so many theory questions in there. So let's start with letter D and move your way up. So, is this a gain from the cumulative effect of a change in the income statement? No. There's no gains and losses from the cumulative effect. So there's no gain or loss. Is this letter C a decrease in net income in 2008? No. What you're supposed to do, you're supposed to take the cumulative effect and adjust the carrying value of the assets and liabilities as of the beginning of the first prior period presented, okay? And then, is this going to be letter B, a decrease in ending inventory in the 2009 balance sheet? Well, no, I think what they said is going to be an increase in the inventory. So the best answer would be answer A. This is an increase in the ending inventory, which is really an increase in the beginning balance of 2009 inventory, because ending inventory for 2008 becomes beginning inventory for 2009. So this is an increase in the ending inventory in the 2008 balance sheet. Now, it doesn't say that they're comparative statements, but usually 2 statements are usually presented as this. So I think the best answer for number 9 is to increase the inventory, do this for the beginning balance of the earliest period presented. They don't say they're doing a comparative statement, but the best answer here would be answer A for number 9. Okay? Let's see if we can do another multiple choice question. Another multiple choice question would be multiple choice question number 13, please. Number 13. Number 13 says, assuming an income tax rate of 40% for all years, Statement of Financial Accounting Standards number 154 requires that the cumulative effect of this accounting change be reported by PO as an increase, as what? As an increase, a decrease, a cumulative effect. What is that going to be? Okay, remember that you'll take the cumulative effect, which is the difference between the old and new accounting principles since the company first started business until the beginning of the first period presented, and you'll adjust the carrying values of assets and liabilities as of the beginning of the first period presented, as the beginning of the first period presented. So it's an asset and liability focus. Number 13 on page 113 says, on January 1st of 2009, the Poe Construction Company changed to the percentage of completion method of income tax recognition for financial statement reporting, but not for income tax reporting. Poe can justify this change in their accounting principles. As of December 31st, 2008, Poe compiled data showing that income under the completed contract method aggregated $700,000, okay, and aggregated $700,000. In the percentage of completion method, if the percentage of completion method had been used, the accumulated income through December 31st, 2008 would have been $880,000. Assuming that an income tax rate of 40% for all years, SFAS number 154 requires the cumulative effect of this accounting change would be reported by Poe as what? Okay, well, how would you affect this? Well, would it be answer, let's start from the bottom, letter D. Would this be an increase in your ending retained earnings of $180,000? Well, what's going to happen is that you would actually make the offsetting entry to retained earnings net of tax effect. So what makes answer D wrong is the fact that it says, answer D says an increase in retained earnings. It would be an increase in retained earnings, but you would have to do the increase in retained earnings net of tax effect, because if you look at my handout, under 1A, steps in dealing with changes in accounting principle, you just use a new accounting principle in the current period. You take 1B says you take the cumulative effect, which is the difference between the old and new accounting principle since the company first started business until the beginning of the first period presented. You adjust the carrying values of assets and liabilities as the beginning of the first period presented. Then one little I says the offsetting debit or credit is made to the beginning balance of retained earnings, but you have to do it net of tax effect for the first period presented. So what makes answer D wrong is that you do increase retained earnings, but it's not done net of tax effect. The difference is between the $700,000 and the $880,000. That's a difference of $180,000, but the credit to retained earnings would be net of tax effect. Now, to take anything net of tax effect, you just have to multiply it by 1 minus the tax rate. So 1 minus 40% would be 60%. 60% times 180,000 would be 108,000. So that's not going to be the answer. Answer number C says a cumulative effect adjustment of 108,000 on the income statement. No, you don't do anything on the income statement. Letter B says a decrease in the beginning balance of retained earnings for 108,000 in 2009. Well, that's kind of sort of correct. You do affect retained earnings for the net of tax effect of 108,000, but it's not a decrease. It's an increase in retained earnings. So the best answer then would be A. It is an increase in construction in progress for 108,000. See, what happens is when you're going from the completed contract method to the percentage of completion method, you're not going to put construction in progress under the completed contract method until you actually complete it. So you delay the recognition of the asset and you delay the recognition of the revenues. What happens, though, if you switch to the percentage of completion method, you recognize revenue and you recognize construction in process, the asset, as you construct it. So if you have a 10-floor building, as you construct 5 floors, you get to recognize half of the revenues. Well, not exactly, but it works like that. It's based on your weighted average of accumulated expenditures. Phil will talk to you more about that when you discuss that. I believe you do that in module either 7A for construction method accounting, or maybe it's inventory, but you do that with Phil. So what happens is you increase your assets as you do more construction. So as you finish the job, you increase your assets, you increase your revenues. So if you go from the completed contract method, which delays recognition of the assets and the revenues, to percentage of completion method, which accelerates the recognition of assets and revenues, you're going to have a larger construction and process account, which is the asset account. And that's what you're supposed to do, is increase that for the cumulative difference. Okay? So the best answer is A, an increase in the construction in progress for $180,000 in the 2008 balance sheet. And you do that as to the beginning balance of the assets and liabilities for the earliest period presented. Now remember, when you do this, always you can choose A, but when you choose A, what do you have to do? You have to make sure that's the right answer. Make sure that you eliminate all the other answers. All right, what was wrong with B and C? B was a decrease in retained earnings. That's wrong. C was to the income statement. That's wrong. It's always a balance sheet focus, not an income statement focus. D was wrong because you have to do retained earnings net of tax. So the best answer then would be A. All right, let's take a look at another one. Let's take a look at multiple choice number 17, please. Number 17. Number 17 is also found on page 113. This is a theory question. Number 17 says, if it's impracticable To determine the cumulative effect of accounting change to any of the prior periods, the accounting change should be accounted for as what? Well, if you can't figure out anything that's going on, you should just apply it on a prospective basis, which is it affects this accounting period and future accounting periods. So the best answer here would, if you can't figure out the accounting for any prior periods, the best answer is to treat it as a prospective basis. It affects this accounting period and future accounting periods. So the best answer for number 17 is B, like Barbara. The best answer is B, like Barbara. Okay. All right, let's now move on to something that's a little bit easier, and that is the change in accounting estimate. Remember, back on my handout at the top of page 3, remember there's 3 kinds of accounting changes. The 3 kinds of accounting changes at the top of my handout are, on top of my handout on page 3, is change in accounting principle, which we just went over, changes in accounting estimate, and changes in reporting entity. Now, I know, I'm telling you, changes in accounting principle is hard, okay? And you're probably like, this is kind of fuzzy, I don't really understand it, but guess what? I'm going to do a simulation with you. Okay, but of course, they had to keep the same stupid typographical error that they had last year. Remember, don't forget to correct the typographical error. Okay, the next thing we're going to do is changes in accounting estimate. That's a little bit easier. And then finally, we'll end. After I do change in accounting estimate, I'm going to do change in reporting entity. I will do the simulation for you for change in accounting principle. You'll probably understand it better. All right, now on my handout, turn to page 4. Changes in accounting principle at the top of page 4. Changes in accounting estimate, letter B. This did not change. I'm on the top of page 4 of my financial accounting reporting handout. Changes in accounting estimate, this did not change. Except that now, changes in depreciation method, amortization method, and depletion methods are now considered to be change in accounting estimates. They are no longer changes in accounting principles. So that's what they're going to try and trick you with on the exam. They're going to say, oh, we changed our accounting method. We changed from straight line to double declining balance or whatever. We're going to change our depreciation method. And they're going to want to say, are you supposed to give this a change in accounting principle type treatment? No, it's a change in accounting estimate treatment, which is prospective, means it affects this accounting period and future accounting periods. Okay, it's prospective treatment. So let's take a look first at item 2. What are changes in accounting estimates? Change in accounting estimates examples are, besides changes in depreciation, amortization, and depletion methods, other examples are, letter A, changes in percentages for bad debt expense or warranty expense, and letter B, changes in the salvage value or the estimated useful life for depreciable assets. Remember that the bad debt expense and warranty expense, the percentages you use are just accounting estimates. The salvage value or the useful life of a piece of property, plant, and equipment, that's just an estimate. If you change these things, there are changes in accounting estimates. Don't forget, any change in depreciation, depletion, or amortization method is treated as a change in accounting estimate. It is not a change in accounting principle. So item 1, what are the steps in dealing with the changes in accounting estimate? 1A, just use the new accounting estimate in the current accounting period. Letter B, do not restate the financial statements of prior periods. Remember, if you restate the statements of prior periods, that's called retrospective treatment. You don't do that for changes in accounting estimates. This is called prospective treatment, when you just take this year and move on to future years. It affects this year and future years, affects the current period and future accounting periods if applicable. All right, what we're going to do is we're going to take a look at multiple choice questions. Number 2 and number 3. This is going to be a change in accounting estimate. Number 2 and number 3. Number 2 and number 3 is a block of questions. It's found on page 112. Now, if you get a block of questions like this, first you should read the stems first. The stems, remember, are the last sentences before the A, B, C, D. So on page 112, now you know on the exam, you don't have A, B, C, D. You just have the first, second, third, and fourth radio buttons, which you click, right? But you all know what I mean when I say A, the first one. Okay. Number 2 and number 3 on page 112 says, number 2, in its 2009 income statement, what amount should Warren report as the cumulative effect of this change? Okay. Number 3 says on January 1st, 2009, what amount should Warren report as the deferred income tax liability as a result of this change? All right. Items 2 and 3 are based on the following. On January 1st of 2007, the Warren Company purchased a $600,000 machine, has a 5-year useful life and no salvage value. The machine was depreciated by an accelerated method for book and tax purposes. The machine's carrying amount was $240,000 on December 31st, 2008, so they've been depreciating it for a couple of years. On January 1st of 2009, Warren changed to the straight line method, so they're doing a change in depreciation method for financial reporting purposes. Warren can justify the change. Warren's income tax rate is 30%. In his 2009 income statement, what amount should Warren report as the cumulative effect of this change? And the answer is 0. This is not a change in accounting principle for which you calculate the cumulative effect. This is called a change in accounting estimate. For a change in accounting estimate, you just use a new depreciation expense calculated under the new method. Use it for this year, you move forward. That's called prospective treatment. There's no cumulative effect. There's no retrospective treatment. They're trying to fool you because under the old standard, a change in depreciation method was considered to be a change in accounting principle. Under the new standard, standard number 154, a change in depreciation method is considered to be a change in accounting estimate. So you just move forward, use the new depreciation method, calculate new depreciation expense for 2009, and move forward. It does not affect any income statement, any statement. You don't have a cumulative effect or anything like that. So item 2 says, in its 2009 income statement, what amount should Warren report as the cumulative effect of the change? The answer is letter D, 0. Number 3 says, on January 1st, 2009, what amount should Warren report as a deferred income tax liability as a result of this change? The answer is D, 0. There's nothing. No, there's no effect to assets, liabilities, deferred income tax items, or impairment loss. There's no effect. Why? Because this is not a change in accounting principle. It's a change in accounting estimate. Okay, so there's no cumulative effect. So the best answer for numbers 2 and 3 are D, like David. Okay, they're just trying to fool you. Let me tell you, if they're going to fool you with that, that's what they're going to fool you with, okay? I'm telling you, that's what it's going to be. Why? Because they're just mean. Remember, this is just an exercise in passing an exam. I'm not here to make you a better accountant. I'm not here to teach you accounting. I'm just here to teach you how to get through the exam, all right? Please, my handouts, please don't use them at work. All right, the handouts are just little cliff notes, quick and dirty ways to learn something so that you can pass the exam. Please don't try and apply generally accepted accounting principles using my handouts at work. That's not going to work, all right? This is only for studying for the CPA exam for financial accounting reporting. Please don't take my handouts and try and use it in regulation. No, that's not going to work. Okay? It's only for financial accounting. It's only for studying for the CPA exam. Don't show your boss my handouts and try to do stuff like this at work. It's not going to work. For that, you will consult Kiso and Wiggins Intermediate Accounting. Or, wait, the current text. Oh, by the way, where would you find all the accounting changes? Let me see. Under A for maybe accounting changes. Anyway, so, all right. Okay, let's just take a look at another couple of multiple choice questions. Cindy's just getting a little bit punchy. We're going to do numbers 20 and 21. 20 and 21 are found on page 113 and kind of hangs over to page 114. So 20 and 21 on page 113 and 114. Number 20 says, remember to read the stem first. The accumulated depreciation for this machine should have a balance at December 31st, 2008 of what? On January 1st of 2005, the Flax Company purchased a machine for $528,000, and they depreciated it by the straight line method using an estimated useful life of 8 years with no salvage value. On January 1st of 2008, Flax determined that the machine had a useful life of 6 years from the date of acquisition and will have a salvage value of $48,000. Okay, so basically they're telling you they're changing the estimates of the useful life and they're changing the estimates of the salvage value. An accounting change was made in 2008. This is called a change in accounting estimate, all right? Because they're changing the salvage value and the useful life. An accounting change was made in 2008 to reflect this additional data. The accumulated depreciation for this machine would have a balance at December 31st, 2008 of how much? Now remember, because this is a change in accounting estimate, we're changing the useful life and the salvage value for this machine, you're just going to give that prospective treatment, which means it affects depreciation expense for this year and future years. You do not go back and change anything you did for prior years. So it only affects 2008 and going forward. So let's see what we can do for this. I'm like stepping on all my books here on the floor. Multiple choice number 20. On January 1st of 2005, the Flax Company purchased a machine for $528,000, and they depreciated by the straight line method using an estimated useful life of 8 years with no salvage value. So when you calculate straight line depreciation, the straight line depreciation method is going to give you the historical cost minus the salvage value divided by the useful life. The historical cost for this asset is $528,000. They're telling you that the salvage value is 0 and that the useful life is 8 years. When I calculate the depreciation for that, that's going to give me depreciation expense of 528 divided by 8. $66,000 per year. So here then is going to be my accumulated depreciation account. And we bought this asset in 2005. So 2005, 2006, 2007. I've recorded then depreciation of $66,000, $66,000, and $66,000. So then as of December 31st of 2007, my balance is $198,000 in here. And then it says that on January 1st of 2008, I then determined that the machine has a useful life of 6 years from the date of acquisition and will have a salvage value of $48,000. So I'm revising my estimates. An accounting change was made in 2008 to reflect these data. So as of December 31st, 2007, which is really January 1st, 2008. What is the carrying value of the asset? Well, you have your historical cost, which is $528,000. You subtract the accumulated depreciation. This is as of December 31st, 2007. You subtract the accumulated depreciation. The accumulated depreciation so far is minus $198,000. So the 528 minus the 198 is going to give you $330,000. This is your carrying value. Then you're going to have to revise the depreciation. That's the carrying value of December 31st, 2007. As of January 1st, 2008, they make all their changes to the estimates. So then you have to recalculate the depreciation. So then at January 1st of 2008, you're going to take the carrying value, which stands at January 1st, which is the same thing as December 31st, 2007. That's the same thing as January 1st, 2008. You take the carrying value, which is $330,000. You're now going to subtract the revised salvage value. They now tell you that the revised salvage value is going to be $48,000. And then you're going to divide that by the life that remains. Life remaining. The life remaining was, first they said it had a useful life of 8 years. Then they're revising it. They said it's a useful life of 6 years from the date of acquisition. Well, since we've already depreciated it for 3 years, if we're now revising the life of a total of 6 years, we've already used 3 years, so we only have 3 years remaining. So the life remaining is 3 years. So then that's going to give you 330 minus 48 is $282,000. So you take the $282,000 and you divide that now by 3 years remaining, and that's going to give you a revised depreciation expense now of $94,000. So that in 2008, the depreciation expense you're going to record is $94,000. And now the accumulated depreciation is going to be the 94 plus the 198, and that's going to give you an ending balance in accumulated depreciation at 12/31/2008 of $292,000. And the reason I'm showing you this is they could ask you all kinds of things about this, all right? Then this particular question in number 20, they want to know the accumulated depreciation for this machine should have a balance at December 31st, 2008 of how much? They could ask you, number 1, what is the revised depreciation expense for 2008? The revised depreciation expense for 2008 is going to be $94,000, but that's not what they ask you. But they could ask you that. Number 2, what is the ending balance in accumulated depreciation as of December 31st, 2008? The ending balance in accumulated depreciation as of December 31st, 2008 is $292,000. Now that's the question that they ask you. So the correct answer is A. You can choose A, but only if you're sure. Now they can also ask you, what is now the carrying value? Well, at December 31st of 2008, the carrying value would be, you take the historical cost of $528,000, then you would subtract the accumulated depreciation. The ending balance is $292,000. And the carrying value now, as of December 31st of 2008, it's a $528,000 minus the 292 is going to give me 236,000. So they could also ask you, what is the carrying value of the asset, or what amount you report the asset on the balance sheet at its carrying value or book value of 236,000? But that's not what they ask. Okay? So what are the things they could ask you? What is the new depreciation expense? What is the ending balance in accumulated depreciation? What is now the carrying value of the asset as of December 31st, 2008? Here they ask for the ending balance accumulated depreciation. The answer is 292. The answer is A. Now let's take a look at number 21. Number 21 says, how should the effect of a change in accounting estimate be accounted for? Well, we saw that. It's just prospective treatment. We didn't change any of the depreciation that happened in 2005, 2006, or 2007. You just change it, make the change in 2008, and you move forward. Okay? So how should the effect of a change in accounting estimate be accounted for? I'm looking at number 21 at the bottom, page 113. Take a look at letter D. Does it affect letter D in the period of change and future periods if the change affects both? Yeah, that's the correct answer. The best answer is D, like David. Let's take a look at the other answers and see why they're wrong. Letter C says it's a prior period adjustment to the beginning retained earnings. No, it's not a prior period adjustment. No. We don't touch retained earnings. We don't go back for prior periods. It's just prospective treatment. We affect this period and future periods. Letter B, by reporting pro forma amounts for prior periods, that's like the BS answer. They're just making that up. How about letter A, by restating amounts reported in the financial statements of prior periods? No, you don't restate. If you restate prior periods, that's considered to be a retrospective application. Retrospective application and retrospective treatment is only done for changes in accounting principle. This is a change in accounting estimate. If given prospective treatment, it affects this period and future periods. So the best answer for number 21 is going to be D, like David. Okay. The last type of accounting change is, go back to page 4 of my handout. The last type of accounting change, and remember, corrections of errors are not accounting changes. Corrections of errors are not accounting changes. They're just called corrections of errors. They're typically called prior period adjustments. You do adjust the beginning balance of retained earnings net of tax, and the only term that they use now is the term restatement. Restatement specifically is reserved for corrections of errors. In the middle of page 4, the last item on page 4 is going to be letter C, the changes in reporting entity. Remember, you have 3 types of accounting changes. Remember, accounting changes does not include corrections of errors. You have change in accounting principle, that is the hardest one. Change in accounting estimate, we just went over that. Now we're going to be change in reporting entity. Change in reporting entity is you're redefining the entity for which you're doing the financial statements. So, first of all, changes in reporting entity. This did not change except for the terminology that they used. Number 2 says, what are changes in reporting entity? What are the examples of changes in reporting entity? 2A says, leaving out a subsidiary when it's being controlled by the bankruptcy court, but then including it once it emerges from bankruptcy. And letter B, leaving out a foreign subsidiary when it's being controlled by a foreign government, but then including it when there's a change in the foreign government's policy. Okay, what does all this mean? Okay. You will learn with Phil when he does business combinations and business consolidations. Whenever you own greater than 50% of the outstanding shares of another company, of a subsidiary, you're supposed to consolidate them with you because you have control over them. Control means you own greater than 50% of their outstanding shares. So A owns company B, outstanding shares, they own greater than 50%. You're said to have control, you're supposed to consolidate them. Well, sometimes you can own 100% of the company's outstanding shares and you still have no control. That happens in a couple circumstances when, for example, they're about to go bankrupt. So if you have a subsidiary that's in bankruptcy court, all right, so right now they're in Chapter 11 bankruptcy and they're trying to do a Chapter 11 reorganization. Who has control over that subsidiary? Not you. The bankruptcy court and bankruptcy trustee has control of that subsidiary. So since, even though you own 100% of their shares, because you cannot control them, you're supposed to exclude them. So let's just say they're in bankruptcy court in 2008, so you exclude them, and it's appropriate to exclude them when you do financial statements for 2008. But let's just say now in 2009 they emerge from Chapter 11 and you can control them again. What that means in 2009, you include them, and if you do a comparative statement where you compare 2009 with 2008, you have to restate 2008 as if they had always been with you. That's called a retrospective treatment. okay, as if they'd always been with you, all right? And that's proper to do because now they've emerged, and you want to make sure that the information is comparable 2009 with 2008. So 2008, it was appropriate to exclude it, but once they emerge in 2009, it's appropriate to include it, so you include it in both 2009 and 2008 on your balance sheet. Okay? That's called retrospective application. Same thing with a foreign subsidiary. Let's just say that you have a subsidiary, it's in a foreign country, that foreign government in that foreign country is just not very friendly towards you, towards the United States and their policies. So they say, no, and they meddle. No cash comes out of the country. We're running this company. And you're afraid they're going to nationalize it, meaning they're just going to take it and say, get out. Okay? But the thing is this. You own 100% of their outstanding shares, but you have no control over them because the foreign government is very unfriendly towards you in 2008. So in 2008, because the foreign government is unfriendly, you have no control. So in 2008, it is appropriate to exclude that foreign subsidiary. In 2009, they have a major change in the government. They have an election, and now, let's hope it was an election, not a coup. But what happens? A political coup. So what happens then is now the new government is much more friendlier towards the United States, and they say, okay, whatever goes, you can take cash out of the country, you can run this company, we're not going to nationalize it, we want to increase foreign investment in our country. So now they're much friendlier towards you, and now you can control that subsidiary. So you include them in 2009, and when you do a comparative statement, a balance sheet of 2009 and 2008, you would restate 2008, called a retrospective application, as if they had always been with you. It was appropriate to exclude it when you do 2008, but in 2009, it's appropriate to include it in both the 2009 and the 2008 column for comparative purposes. Okay, that's called a retrospective application. All right, changes in reporting entity. Number one, steps in dealing. So remember, C, this is changes in reporting entity. This does not change except for the terminology. Number one says steps in dealing with the changes in reporting entity. Number 1A says just use a new reporting entity in the current accounting period. Number 1B says you must restate the financial statements of all prior periods that are presented. Remember, for the income statement, a statement of cash flow, you present 3 years comparative statements. For balance sheet, it's 2 years. This is called retrospective treatment. It used to be called retroactive treatment under the old accounting standard. Now, I only give you the old accounting term because they use retroactive. They're trying to fool you with that term. Remember, that's the old accounting standard. Now they say it's retrospective treatment when they restate the financial statements. And the term restatement is specifically reserved just for corrections of errors. Let's take a look at a couple multiple choice questions on that. Let's take a look at multiple choice questions number 25 and 26. Number 25 and number 26 are done on page 114. Number 25 and 26 on page 114 say, number 25 says, SFAS number 154 requires this to be reported as what? So how do you report it under the standard? By the way, if they mention the standard number on the CPA exam, they will also tell you the standard title. Now, just trying to be lazy here and save, typing, save space in the book. But if they give you the accounting standard number, they will also give you the accounting standard on the exam. 25 says, a company has included in its consolidated financial statements this year a subsidiary it acquired several years ago that was appropriately excluded from consolidation last year. So last year it was appropriate to exclude it. This year it's appropriate to include it. Standard number 154 requires this to be reported as, is it letter A, an accounting change that should be reported prospectively? No, the prospective treatment is a change in accounting estimate. This is a change in reporting entity which requires retrospective treatment. Is it letter B, an accounting change that should be reported retrospectively? Yes, that's the correct answer. The answer is B, like Barbara. Is it letter C, a correction of an error? No, it was appropriate to exclude it in 2008. It's appropriate to include it in 2009. So it's not a correction of an error. Is it letter D, neither an accounting change nor a correction of an error? No, that's not the correct answer. The answer is B, like Barbara. That's the best answer. It's accounting change that should be reported retrospectively. You include them for the current year and you restate all prior periods presented. Number 26, which of the following statements is correct regarding accounting changes that result in financial statements that are in effect the statements of a different reporting entity? This is called a change in reporting entity, right? Is it letter D, like David? The financial statements of all prior periods presented are adjusted retrospectively. That's the correct answer. But let's see why answers C, B, and A are not right. Answer C says, no restatements or adjustments are required if the changes involve the cost or equity methods of accounting for investments. That's like the BS answer, okay? Letter B says, no restatement or adjustments are required if the changes involve consolidated methods of accounting for subsidiaries. No. take a look at answer A. The cumulative effect adjustments should be reported as a separate item on the financial statements pertaining to the year of change. That is a change in accounting principle. If they're telling you it's the statements of a different reporting entity, that is a change in reporting entity, and that requires retrospective treatment. That means you use a new reporting entity for this period, and all prior periods you present, you include them as if they had always been included with you. All right? So the best answer then would be answer D, like David. Okay, the answer is D, like David, for number 26. Okay, the next thing that I want to do is I do want to go over the simulation. Okay, the simulation is simulation number 2. Remember, in simulation number 2, I only want you to do the accounting change section only. Simulation number 2. The accounting change only starts on page 118. Let's just read over the facts. I'm obviously not going to finish this on this disc. I will continue on to the next disc with simulation number 2, the accounting change only. Turn to page 118. In the middle of page 118, see the bigger box says accounting change. Let's just go over what they're doing here. Okay? What they're saying here is on January 1st, oh, first of all, what's the requirement? At the very bottom, they say prepare the adjusted income statements for 2008 and 2007 after the change to the FIFO inventory method. So what this is going to be a change in accounting principle. We're actually going to restate, it's called a retrospective treatment. We're going to recast the statements as if they had always used the new method. On January 1st of 2008, the Falk company changed from the average cost method, which was the old method, to the FIFO method, which is a new method, to account for its inventory. Then they have ending inventories under each method. So they have ending inventory for 2007 and ending inventory for 2008 under the average method and then the FIFO method. Remember, the average method is the old method and the FIFO method is the new method. So under the average method, it's 5,000 and 9,000 for 2007 and 2008. Under FIFO, the new method, it's 7,000 and 14,000. So you can see it's quite a bit of a difference. And then they say, this is Fox income statement information calculated under the old method, which was the average cost method. And this is a typical multiple-step income statement format where they take the sales minus the cost of goods sold to give you the gross profit, minus the operating expenses to give you net income before income taxes. Then they subtract the income taxes to give you net income. Just keep in mind this is under the old method. This is the average cost method. Now remember, this is a change in accounting principle, so it's going to require retrospective treatment. What you're going to do, they made this change in January 1st, 2008. You're just going to use a new accounting principle in 2008, and they're going to have to restate 2007, recast the statements for 2007 as if you had always used that new method, which is the FIFO method. All right. Assume that FOC has no book or tax differences or deferred taxes. FOC accrues tax expenses on December 31st of each year and pays the tax in January of the following year. The income tax rate is 40%. They want you to prepare an adjusted income statement for 2008 and 2007 after the change to the FIFO inventory method. Then also on page 119, it continues. It says they also want you to indicate, turn to page 119, they also want you to indicate the adjusted balances on December 31st balance sheet for each year, and they want you to give the revised balances for inventory, income tax liabilities, and retained earnings for December 31st, 2008 and December 31st, 2007. Okay, what I'm going to do is I'm going to end here, and I will pick up this problem on the next disc. So I'll see you in the next disc, and we're going to finish up simulation number 2, the accounting